This week on Silicon Reel, we have venture capitalist Nic Brisbourne, founder of Forward Partners.
We're there helping to build the company in a much more meaningful way than a traditional VC. From concept, raw idea, through to Series A. As investors, particularly if you're managing a large fund, you want to be in the best companies in the world. Hope without critical thinking is naivety, and critical thinking without hope is cynicism. Striking the balance is key. Having great judgment is kind of one of the differences between success and failure, ultimately. The world is a smaller and smaller place every year. It's a marathon, not a sprint.
Silicon Reel presents Nic Brisbourne, Forward Partners.
Slow down to speed up.
In London, technology is the Silicon Roundabout. Introducing a new talk show dedicated to the people of the London technology startup scene. Silicon Reel. Each week, interviewing entrepreneurs, venture capitalists, financial technology, accelerators, and incubators in an exciting three-person format. Learn about the people behind the innovation. Locally filmed, locally sourced. Silicon Reel. It's about the people. This is Silicon Reel, the weekly talk show dedicated to the people of the London technology startup scene. I am Brian Rose. My guest today is Nic Brisbourne, who is the founder of Forward Partners, an investment business which works with e-commerce companies from raw idea through to Series A, offering a package of investment, proven methodologies, and office space. Nic, you have 15 years experience in the VC industry, investing in over 25 companies in London and Silicon Valley as a partner at the venture capital firm DFJ Esprit. We had Simon Cook on as one of our very original guests, like over a year ago, I think. You also author Europe's most popular VC blog, The Equity Kicker. It's fantastic. I was reading through it today. You write a lot, too. It's like once every day or every other day.
Once a day, yeah.
Fantastic viewpoint you have, backed up with lots of scientific evidence, which an MIT engineer loves. Nic, thanks so much for being here, and welcome to Silicon Reel.
Thank you.
You know, we met at the ICE Christmas dinner, and we were hanging out, which is a fantastic group of entrepreneurs here in London that's kind of chaired by Mr. Alex Hoy, who's also been on this show. And we were talking at dinner, and I know you said to me, you were a venture capitalist for so many years, and then you wanted to do something different. You kind of wanted to use a different methodology from the one you were so used to, and the one that we know as VC. And I was wondering what that idea was, and if Forward Partners has become what you had envisioned.
Cool. So in many ways,
how's that for a question?
That's good. I like that. That's it's become more than Forward Partners has become more than I envisioned actually. So what I wanted to do was to get earlier stage and to find a way to add much more value to our portfolio companies.
Okay, because you were later stage with VC.
Yeah, we were Series A, Series B, so
okay.
Still pretty early stage, but. As businesses get more capital efficient, I increasingly think that really the first money and that first £500,000 is where it gets really exciting. It's where the company's formed, where when things go well, they can go really well, really fast, and you get the most value appreciation.
Okay.
So I wanted to get early stage, and then when you are investing early stage, then there's less money, and so the other parts of the package become more important. And so I started thinking like, well, what does that actually mean, right? What is the other part of the package? What should it be? And what we were doing at DFJ, and what all great VCs, at Series A and Series B level around the world have done for a long time is, we work really hard for our portfolio companies, and you make sure that you have a good network of people you can connect them to for sales or for recruitment or to help sell the company, that sort of thing. And then you also work hard to be able to offer them advice at the board table. You have a lot of experience at different companies, how to grow a sales team, how to think about digital marketing, this sort of stuff. But I wanted to move beyond the advice in the contact book, so I talked to a bunch of entrepreneurs, asked the question, if you could have help from your investor, what would it be? And everyone majored on biz dev and recruitment. So when I was first thinking about leaving DFJ and adding more value to the portfolio, those were the areas I was thinking about the most. But when I came to Forward and started talking with Neil Hutchinson, the founder of Forward there, they had what was at the time called Forward Labs, and there they were helping build startups from day zero, with help with biz dev and with recruitment, but also with development and design and marketing. And I could see there the beginnings of a package which was just really powerful. Kind of a suite of everything that an entrepreneur needs to get started. And so then, we kind of took that package and thought, how do we work this? How do we make it so it's really attractive, right? So the best entrepreneurs will look at us and say, I want to come to them. I want to work with them to get money and to get the help that they offer, because that will give me the best chance of success. And it really, what any individual entrepreneur needs depends on the skills they have. So we've got one guy that we've just backed who's an amazing digital marketeer. So we're helping him a bit with marketing, but that's not why he's come to us. He's come to us for help with product and design and development. That's where we can make the most difference to him. Maybe a bit of recruitment too. Whereas if I look at I'm not going to name names because kind of pointing to the areas where they're not so strong, but I look at some of the others and they're strong on product but maybe don't have the marketing experience, so the balance of help that we give is a little bit different.
Okay. And do they help each other as well? Do any of, I guess, I don't know if you call them portfolio companies, but
we call them partner companies.
Partner companies. Yeah. Okay. It's important. Language is important, right?
Yeah, and we do, again, we're different to conventional VCs, and we do really partner. It's, we're there helping to build the company in a much more meaningful way than a traditional VC.
We've had lots of VCs on here. I've made sure that I've kind of got a lot of the big ones, whether it's Index, we just had Excel on, we've had Balderton on, and they all come on and say, once you're with us and we cut you the check, you're going to have access to our network and you're going to have our time. But then I look at these guys and they're on the boards of 12 companies, and so I know in theory that's what they want to happen, but oftentimes that breaks down.
Those good funds do a great job of helping their companies. We all as investors do get quite stretched, but I've worked with Index in particular in the past, a bit with Axel, and now actually with Balderton more recently. And they're there helping their companies. And they do work hard for them. So people do get stretched at times, but I think particularly for the successful companies, they really do deliver.
Right, but they're later stage usually anyways.
Yeah, that's the key point for us. So, we like to work with the companies, as I say, from concept, raw idea through to Series A, and then we want to get those companies in great shape for an Index, an Axel, or a Balderton to invest and work with them from there. And then we will start to take more of a back seat as they take more of a front seat.
Right. I'm trying to think of a company that would come to you and the company that might walk in the door and say, Nick, we'd love to work with you. Right now, I'm guessing their options are a few. They can maybe go to an incubator or go to an accelerator or maybe just go straight to angel and try to do it on their own. What are their different options, and why should they maybe choose Forward as opposed to those other options? And these days there seems to be so many options.
Yeah.
Too many options, maybe.
So a little bit more about our investments maybe, and we'll help set the scene for that.
Yeah.
So, we work from raw idea through to Series A, but, we think of our investments as falling really at 2 points on that journey. So one really at the concept stage, that's about half our deals, and then the other half are maybe a year away from Series A, so kind of more seed stage deals than idea stage deals.
Okay.
And so for the idea stage deals, then there are no VCs that want to invest at that stage. Most accelerators these days, certainly the bigger ones, they're a little bit later stage. They want to see companies with product and so on.
Okay.
So those entrepreneurs, their choice is really between us and angels. Right.
Yeah, you've said before that sometimes you're their only option for institutional investment.
Yeah, exactly. Us and angels. Yeah.
Okay. So how do you start that early? How do you recognize someone with a good idea and invest in them? Is that the $1 million question?
Well, that's what we've set at our stall to do, and a lot of investors are going later stage because so the argument for people who only want to invest once there's a product in the market is it's super cheap to get a product to market, and so if you've got anything about you as an entrepreneur, you can find a way to do that before you need to come to me for money, and then I can have a look at the product and see whether it's resonating with customers, and that's the basis for my due diligence to a large extent.
Right, that's the classical thinking,
yeah.
And we've heard it so many times on this show. It's the minimum viable product, get it done, go to Google Campus, make sure it happens, and then start talking to people.
Yeah. And you see, to me, that misses a huge opportunity, which is, there are a bunch of great entrepreneurs there, particularly business-oriented entrepreneurs. And if you say to them, I only want to talk to you once you've built a product and got a little bit of traction, then, which is the message they've been hearing, then the only option they have is to run around, try and find a tech co-founder, and the business co-founders outnumber the tech co-founders kind of 3 or 4 to 1 in London. We go to these tech co-founder events because they're hunting ground for us.
Right.
And we ask the question, we sponsor these things and do a little talk at the beginning. How many of you here are founders, solo founders? How many of you business, like maybe 60, 70% of the audience? How many of you are technical founders? And it's like 20%. And so these business-oriented founders, they have to work really hard to sell their companies to these tech co-founders who take very often large stakes, and and they're getting married to people that they barely know. And
so the tech guys are running the business transaction more than the business guys.
Yeah, like the balance of supply and demand is way skewed towards.
Is that a London issue? Is that because the business people come here, or is it the same in Cambridge?
It's the same Cambridge, same in California.
Interesting.
And the reason is that if you're a technologist and you want to found a company, then you can build the first version of the product yourself, right? If you haven't, and so half of those guys just do that, right? And so they go out of the market, and so there's always going to be an imbalance.
Interesting.
And so that and that's where we play. So the sweet spot for us is people who've got some experience, got a 5 to 10 years of experience, know the domain well, have got a great idea, and then we can work with them to really flesh out the idea, make sure it's great, make sure that the first version of the product built is one that really resonates with customers. Find those first customers, get the economics looking great, and then raise the Series A.
Okay, so you're looking for the business person with the idea that can't build the MVP, and that's where you specialize.
That's the sweet spot. Yeah.
Okay. Now you specialize in e-commerce. Is that still the case? And why pick such a niche?
So yes, it is still the case, and a big part of what I wanted to do when I left Ford was to be sector focused, and the reason for that is that by being sector focused, you build up some real expertise in an area, and so you make better investment decisions. You're also better able to help your companies because you understand their business better, and your network of contacts becomes stronger in their specific areas. So you become more attractive to the best entrepreneurs, and so that was why I wanted to focus on an area. And if you look at the US, the most successful strategies for venture capital funds over the last 10, 15 years have been twofold. One is the sector-focused fund, so Union Square Ventures stands out as the best example there. They're focused on network businesses.
Okay.
And then the second strategy is higher value add, with Google Ventures, Andreessen Horowitz, and so on. That's kind of younger in its gestation, but that's the other thing that we've picked up.
Okay. As in they really take an active role in the company and brain dump all their knowledge. And like Andreessen Horowitz, they have all of these specialty people as well.
Yeah. So the key thing is you've got a team of people that help you're not just a fund of investors, you're a fund of investors and a team of operators to help the companies.
Okay. So you notice those two things, and that's what you're doing here.
Exactly.
Which is interesting. I haven't heard this business model, and I've done 80 of these shows. So you're kind of doing something unique in London, I would say.
Yeah, no, very much so, yeah.
Okay. And one more question. I was listening to this series, How to Start a Startup, which I think was Stanford University, and they had a lot of people from Y Combinator there and former grads and a bunch of interesting people. And I think the Y Combinator person said that they ran the numbers on their 200 or 400 startups, and they found that the most successful teams were with 2 or 3 co-founders, and that the ones that did it alone had a very hard time. What's been your experience, or is your idea to take that business guy and marry him with a tech person? How have you found a co-founding team success rate? You're a numbers guy. If you run the numbers statistically, what is it like?
I totally agree with the conclusion coming out of Y Combinator. It's so much easier to run a business if there's 2 or 3 of you at the top. It's a hard business running a startup, as you know, and there's just a million things that come at you all the time. And if you've got a partner at the heart of your business, a co-founder, then there's someone who you can, if a problem comes in, you can have your little panic reaction without upsetting the team or upsetting your investors. That's important. If you have, ideas about how you might solve problems or new things you want to try, someone you can talk to when those ideas are only half baked. All those things are super hard if you don't have a partner, a co-founder at the center of your business. And so we're big believers in the importance of teams. Where we kind of look at it in a bit more detail, though, is, you know, do you need to have that partner on day one? You know, if you have that partner, right, if you're a business-oriented person, you've got a great idea and you've got a co-founder, then that's great, right? If you've got someone you want to work with out of the traps, that's fantastic. But if you don't, then the best time to find that person is not straight away when your idea is still kind of pretty half-baked and only really exists in PowerPoint. It's in a couple of months when, you know, you've validated the idea, you've launched your first version, you've got a few customers, only a small number, and you can go and talk to people and say, look, hey, I've got a real business here. This is a real thing. Do you want to join? And at that point, you unlock a much larger pool of more qualified candidates. You know, and these often are techies, and there's a lot of sort of co-founder CTO types who really want to get involved super early stage in startups, but, you know, they've tried it once pairing at kind of day zero with a business-oriented founder, and the thing's flopped because ultimately, you know, it probably wasn't a good idea, right? And so when you go to them with a story of the company that's a couple of months in, and, you know, and it's just got much more substance to it, then they say, okay, like, I've always wanted to join really early stage, and you know, this looks great for me now. And they don't get many opportunities to join businesses like that.
Are you a matchmaker of sorts? Are you Match.com for tech in London?
Yeah, but that makes it feel lonely or somehow, doesn't it, right?
It is lonely out there.
but very much so. So talent is one of the key things that we help our companies with, and helping through that process of figuring out, you know, what sort of co-founder is going to be best for you, and then helping them find that person is very much part of how we help.
I can just imagine about the horrible unions that are going on out there when some business guy bumps into some tech guy. They don't know anything about each other, but they've never met anyone like each other, and they just say, okay, let's do it, because I'm in a scarcity mindset right now because I don't have options. I mean, you must see that all the time.
Yeah.
Okay.
Yeah, and we see people who have paired up in that regard, in that way, and then we look at it and go, like, that's made, you know, you as an individual we would have invested in, but now there's two of you, it's not working for us.
Right, and it's over. I mean, it's too late, right? And the whole idea is now crushed, and the equity's been split, and now, I mean, like, it's almost you've lost your 1 year, 2 year window, kind of, right?
Well, in the worst case, yes. I mean, so they've got a chance. Maybe we're wrong in that assessment, you know. So they go away and try and do their thing, obviously. But yeah.
Okay. A lot of guys are listening, and women too, and they're thinking, "Wow, how could I be the business person that would impress Nic?" And I'm wondering, what are you looking for? I'm sure there's a bunch of intangibles, but you mentioned earlier you're looking for a certain amount of experience. Are there certain traits, as in they've stuck with jobs in the past, or is it background, education? Is there anything that you found works?
So, you know, there's certainly nothing in background and education. You know, we're huge believers on taking people on merit at the point at which we meet them, not, you know, like they managed to get some degree at a good university or anything like that. So what do we look for? You know, we look for someone who has first and foremost got a great idea, and they're passionate about that, and they can explain it clearly. And, you know, one of the big questions we always have right at the get-go, you know, when an entrepreneur's at the beginning of their journey, it's like, you know, how much are they going to stick with this, right? You know, do we really think that they want it, you know, hard, right? And they're going to stay with it for 5 years or more.
How can you tell that?
Well, so, you know, you look at what they've been doing, right? How hard they've been working on this project in the background. So one of the guys we just backed had been, you know, so he handed his notice on his job the day after he signed the term sheet with us, but for the previous year he'd been working on this company as a side project, and he had a site live, and he got his first few customers, and, you know, he persuaded some developer to work with him for free, and, you know, so, like, you could see, like, and he'd wanted it, and he'd chosen his jobs in order of the previous 5 years in order to build up his experience base.
Okay.
You know, you could feel he wanted it, right? Okay,
so the CV must tell you something, what they've been doing for the past 5 years. I mean, you must be able to...
So in that case, very much so. You know, one before, a company called Lexu, which is a marketplace connecting small companies with lawyers. There, you know, Daniel was a lawyer before, and so what we liked about that, you know, he really understood the lawyer side of the equation, what drives those guys and girls, you know, and how they were going to, you know, how to make Lexu attractive so that they would work with him, and again, you could really feel the drive. So he had been highly successful in his 5 years as a lawyer. That was a big part of it. Okay.
And do you do multiple meetings over a weeks and months process before you choose, or do you get a good feel right away by people?
So you know, we do get a good feel right away, and that is important. But then we do have a process that we go through. So, you know, we keep it quick. You know, we really set ourselves up to to be as entrepreneur friendly as we can. And one of the things that that investors can be very guilty of is spinning entrepreneurs' wheels. Taking meetings when maybe they're not that likely to invest, and then not saying no when they might.
That's the worst, right?
Yeah. So we really work hard not to do that at all, and to keep our processes very fast and transparent. So the way we work with companies at the idea stage is a couple of meetings, one, maybe two meetings, and then we have a workshop process that we use, which is based on the business model canvas, which is a way of looking holistically at the whole company and then working through what are the assumptions behind it. And that helps us to see the assumptions that are being made, and then we have a stack ranking process which says, okay, so these are the most important assumptions by criticality to the business and how easy they are to test. And we look at those and think, do we believe those? So they need to be proven, but what's our gut telling us? And if we think they can be proven, then that's a really great sign for the company. And then we talk with the entrepreneur, right? This is how we're seeing this. Do you see it in the same sort of way? If we invest, the first thing we should do is to try and validate these assumptions. And then that becomes the work plan for the first couple of months after we've invested.
How do you say no? And do you usually try to give it a time frame in your mind when I have to get back and give these people yes or no's?
We try and do it very quickly. We haven't done this yet, but one of the things I'd like to get to in the next year or two is a clear, almost like an SLA for entrepreneurs. Like if you contact us, we'll reply within this sort of time frame, and if you meet us, we'll get back with a decision again within a couple of days. We just started actually sending out questionnaires feedback questionnaires after we meet entrepreneurs.
Nice.
So we can see, we can get some feedback, right? Did we set this thing up effectively? Were we present in the meeting appropriately? Did we ask the right questions? Did we get back to you when we said we would?
I want to know what you think is the future of funding for startups in London. Every week I turn around and I seem to see a kind of a new accelerator, a new incubator, a new Fortune 500 company that's coming in and saying, now we're going to accelerate here, accelerate there. And I got a funny feeling that these are going to continue for the next couple of years. And there's so many options. I think there's like 5 or 8 different fintech accelerators out there. Is London over accelerated? Is that the wrong choice for certain people to go on these 90-day programs, or should they be thinking about doing something else?
So I think we do have too many accelerators. I think, particularly corporate accelerators are mushrooming. And if you look at the motivations for corporates, a lot of these big companies, they desperately want to harness more innovation somehow, and they don't know how to do that. And running an accelerator is one way that might deliver that benefit for them.
It's a cheap
and
way
it's
of
pretty
doing
cheap, and
right.
they get some good column inches, some good marketing benefits. And so I think there's a lot of that going on. I think that, probably they won't get the benefits they hope out of it, but, that's a wave that'll take a couple of years probably to work its way through. That said, depending on the program, right? If you're not taking any equity, then, why not?
Right.
Go and do this for 90 days. You get from free office space, you get your networks get a bit better. And, one of our companies, in the logistics space, as a logistics provider, I wouldn't say who they are, but they're just setting up an accelerator program, and I was like, wow, even they're setting up an accelerator program? What's the deal? No equity, we get to know them a bit better, and we get to meet some other people, and then potentially acquire one day, and so why not, right?
Right. Okay.
Yeah.
And the corporate ones don't usually take equity, right?
Some do, some don't.
Okay.
But if they don't, then it's so we backed a company called Dataloop last year that had been through the Microsoft Accelerator,
Right.
And it was just they got free office space and some good networks for 90 days, and they just used that, right?
Yeah, no, I bumped into a few people that have asked me that, and it's kind of like, what are you doing now? Plus, a lot of people, since they don't have the means outside their current full-time job or whatever they're doing, like, what are you actually going to be doing in 90 days from now? Maybe not much else. So this could be a great way for you to get the knowledge, get a network, talk to people, don't give up equity.
Yeah.
And there's something there. Now, what if you're giving up 8% of the equity and you're going on, a 90 or 100-day startup? Does that change things?
Yeah, totally. Right. That's getting on for 10% of your company.
But it's only 10%.
It's only 10%, but 10% here, 10% there, and pretty soon you're talking real money. And so at that level, some of them are great, some of them are not. and you need to take a very careful decision about whether it's worth 10% of your company. It also depends on what your strengths are. So, as an entrepreneur, so I think what a lot of these accelerators are really good for is helping people to really quickly build out their networks. Particularly if you're coming from a foreign country, from Eastern Europe maybe, you arrive in London, then 90 days with a good accelerator, all of a sudden you're hugely well networked, and that would take you maybe a couple of years otherwise. So that can easily be worth 7-8%.
Right.
What we're doing, working with companies for a much longer period of time, over a year, is that period of time enables us to really build a solid business, right? Help them build a product, get customers, validate the economics, and hence drive a big increase in valuation. In 90 days, there's only so much you can do, right? And so I think that, in most cases, the accelerators are good for the use case I just described.
Okay. Biggest mistake startups make? I know it's a general question, but you see it every day. Plus, you've been in this business for so long. Or these days, that might have changed in the last 2 years.
Yeah. Biggest mistake startups make? I think the easiest mistake to make, and the most common mistake, is to have your take the initial vision for a product, an idea, and then just go build that, and not be receptive enough to feedback. Not spend enough time talking to customers, or talking to customers in the right way. So many companies now, they read the Lean Startup, or at least skimmed it, and they want to build a minimum viable product, and then they don't build the best MVP that they could, right? They build one. Maybe they should have built it here, but they build it over here, a slightly different feature set, and then it doesn't really resonate that well, and they're trying to iterate from the wrong base. Actually, there's a phrase that IDEO use, which is slow down to speed up, which I think is really relevant for startups at the early stages. You take a little bit of time to really understand what are the emotional kind of hot buttons around your product for your customers, and once you understand that, then you choose what your MVP should look like, and then you're in a much stronger place.
Right. So don't go too fast into product, which is what we've heard the market been preaching us for a long time, right? You wrote a blog post recently saying good startup hypotheses must be falsifiable. Is this a little bit about examining your product and examining what your methodology is first?
Yes. Yeah. Yes. So it goes into that, definitely into that same milieu. So I think, to the extent that you can have great clarity over what it is you're trying to build and why, and how much of that and how much of that is guesswork at the moment that you're going to test, then you're in a much stronger place.
Okay.
And it's really easy to want to move super fast, and you kind of know, right? You can feel it and what it should be, and so you just want to build, and and as I say, that can end up with not quite the right product, and then you're starting from the wrong place, and the thing will never be as good as it might have been.
All right. So that's the funny thing about startups is a great founder believes in his vision in a completely irrational way, right? Or he wouldn't be doing what he does.
Yeah.
But also a great founder constantly gets feedback from the market in case they need to pivot. I don't even know if you use that word anymore. So how do you strike the balance? And how do you convince your portfolio companies or partner companies to strike the balance? Because sometimes you're dealing with people that are very passionate.
So striking the balance is key, right? And this true in so many areas of life, and it's so easy to say and so hard to do. I read another blog post recently about getting the right balance between optimism and critical thinking, which I think really talks to this point.
Cynicism and naivete were the two extremes, right?
Yeah, exactly.
Was it hope without something? Is it?
Hope without critical thinking. Critical thinking is naivety, and critical thinking without hope is cynicism.
Right.
And you don't want to be either of those, right? You want to be in the middle, but it's a tough balance to strike, and so you need to strive for the balance, and knowing when to listen. Because as an entrepreneur, you get all sorts of advice from everyone. Everyone wants to be a mentor these days and take the coffee, and you get all sorts of advice, much of it conflicting. Knowing which bits to take and which bits to ignore isn't easy, and ultimately that's about your judgment as a founder, and having great judgment is kind of one of the differences between success and failure ultimately.
Right. So you want the right mentors around you.
Well, you've got to talk to a lot of mentors. It's about knowing which ones to listen to, right? Which ones do you go and see again, and which ones do you not?
Right. Talk to me about the boardroom. I know you've had some early experience.